So, let's say you're selling a business or maybe a piece of property. You're probably laser focused on that sale price, right? But you know who's focused on something else? The IRS. And they're focused on getting their cut, like right now. This can create a huge cash flow problem for you. The good news? There's a specific tool in the tax code designed to solve this exact problem. And today, we're going to break down exactly how it works. Okay, picture this. You just sold a property for a cool $500,000. Sounds fantastic, doesn't it? But here's the catch. The deal is structured so you only got $50,000 in cash this year. So here's the real kicker. The $500,000 question. Does the IRS really expect you to pay tax on the full $500,000 right now, even though most of that cash isn't even in your bank account yet? Well, without the right strategy, the answer is a pretty painful yes. This is the trap so many people fall into. You're looking at a massive, maybe even crippling tax bill based on profit you technically haven't even received yet. But with the right approach, that bill transforms into something much, much more manageable, paid off in little pieces only as the cash actually comes in. The difference is, honestly, night and day. So how do you get from that scary, huge bill to the nice, manageable one? Well, the great news is there is a solution baked right into the tax code. And this isn't some sneaky loophole. It's a specific provision designed for exactly this kind of situation. It's called the installment method. First, let's really make sure we understand the problem we're solving. We'll call it the big gain, big problem. You know, it's that classic mismatch, a huge capital gain on paper, but just not enough cash in your pocket to pay the tax man. It's a real headache. So what exactly is an installment sale, at least according to the tax code? Well, it's actually super simple. It is any sale of property where you get at least one payment after the tax year the sale happens in. That's it. You sell something in December, but the first payment doesn't hit your account until January. Boom, you've got yourself an installment sale. You know, the whole idea here, the core principle, is just common sense. You pay tax as you get paid. It just makes sense, right? It perfectly aligns up your tax bill with the actual money coming into your bank account. Okay, but here's something you've got to understand. Not every dollar you receive is profit. Each payment you get from the buyer is actually a mix of three different things. A portion of it is just you getting your own money back, your original investment, or what the IRS calls your basis. That part, totally tax-free. Another part is your taxable gain. And finally, a little slice is the interest income on the loan, which, yep, that's taxable too. So, how does this all work in practice? How do you actually pay tax as you're paid? Well, it all comes down to one specific IRS document, Form 6352. When you use the installment method, the whole thing, really, it all boils down to calculating one single super important number. It's called your gross profit percentage. This percentage is the absolute heart and soul of Form 6052, and it's what's going to determine how much of each and every payment is considered taxable gain. All right, so how do we find this all-important profit percentage? Don't worry, the math is way simpler than you might think. But this one little calculation is the key that unlocks this entire strategy. It's going to be what decides your taxable gain year after year after year. Okay, it breaks down into three pretty simple steps. Let's walk through them. First, you figure out your gross profit. That's just the selling price minus what you have into it, your adjusted basis. Easy enough. Second, you determine what's called the contract price, which is usually just the selling price minus any debt the buyer takes over. And finally, step three, you just divide your gross profit by that contract price. That division gives you the magic number. And there you have it. For our example, let's say that little calculation gives us a gross profit percentage of 60%. So what does this 60% actually mean? It's simple. It means that for every single dollar of principal that lands in your account, from the down payment to the very last one, exactly 60 cents of it is what you'll pay tax on. Okay, so we've got our magic number. Now let's put it to work and see how it actually affects your yearly taxable income. This is where you really see the magic happen. Check this out. This is the power of the installment method right here on the screen. The seller gets a $20,000 principal payment each year, but instead of paying tax on the whole profit up front, they just apply that 60% we calculated. That means in 2024, only $12,000 is taxable gain. And it's the same deal for 2025, 2026, and on and on. The tax bill gets spread out perfectly to match the cash coming in. So what's the big takeaway here? It's pretty clear, right? This method lets you perfectly line up your tax payments with your actual cash flow. You get to completely sidestep that nightmare scenario of having a gigantic tax bill in year one with no money to pay it. It's simple. You pay as you get paid. But, and this is a really big but, it's not a free-for-all. There are rules. So let's get into our final section here. The key rules and, the gotchas. These are the critical exceptions you absolutely have to know before you try to use this method. First off, you need to know when you just can't use this method. It's not for every situation. You can't use it if you sell something for a loss. Nope, you've got to take that loss in the year of the sale. It's also off limits for dealers selling their everyday inventory. And you can't use it for selling stocks or securities on a public market. Now we get to the single biggest gotcha, and this is especially true for real estate folks: depreciation recapture. And the IRS is crystal clear on this point. Any gain that you have because of the depreciation you've taken over the years, it has to be reported as income in the year of the sale. You can't spread that part out. That part gets taxed right away in year one, even if you haven't seen a dime of that money yet. Ouch. And one last thing, you have to be super careful with what's called the related party rule. See, in a normal sale, you report the gain as you get paid. But if you sell to a related party, think your kid or a company you control, and then they turn around and sell that property within 2 years, the game changes. The IRS can make you pay tax on the rest of your gain immediately. Basically, it's a rule to stop families from playing a shell game to avoid taxes forever. So, we've seen how the installment method can be a really powerful tool for managing a huge tax hit. But it isn't automatic, and it definitely has its own set of rules and traps. So, at the end of the day, the question you've got to ask yourself is this: is strategically delaying your tax bill the right move for your specific financial picture? Understanding the answer to that is really the key to a successful sale.